Hickman is a longtime friend of mine. He's been in this business for several years now and is really a top producer at Symmetry. And it's been one of those things where, knowing he's got a tremendous background and market expertise that is very unique. He's got perspective, from a lot of different levels, but certainly understanding how market risks, affect, can affect retirement, can affect, capital growth, that sort of thing. For me, it was an opportunity to bring, really truly a subject matter expert, to the forefront and kind of share what some risks might be. And down the road, we wanted to do a three-part series, not only just kind of go give an overview of the risk, but also to talk about, at the end of the day, what might be some options to protect against that risk. So, with that, I'm going to give the floor to Jay.
Thank you, Brian. And I'm going to share my screen. Give me 1 second. I don't spend too much time on me, but just very quickly, my background. I spent much of my career as a securities analyst, Wall Street analyst, and a portfolio manager, longtime entrepreneurial investor. So I'm now a licensed agent. I'm a fiduciary. Okay, that's the best interest standard in the life, annuities, health, and accident space. I came into this phase of my career during the pandemic and started to learn about some product only available through the life insurance industry that I never knew existed. And it got me kind of excited. It really dovetailed seamlessly with a lot of the themes that were very, very important to me as I talked to institutional investors and registered investment advisors over the course of my career. So before we get started, I do want to share this screen with you. This is for informational purposes, okay? We're trying to educate and help people understand. We're not trying to sell anybody anything. We're not trying to give investment advice, legal advice, etc. So just keep all that in mind. With that said, I'm going to make a blanket statement right up front. Protecting against the downside in the stock market is something that hundreds of billions of dollars is chasing institutionally. Finding ways to participate in a strong market, but be protected in the event of the really significant down markets, in some cases, catastrophic markets. There's a lot of money chasing it. And if you don't have access to some of the best alternative asset classes in the world, the top performing venture capital funds, the top performing private equity, hedge funds, real estate funds, and let's face it, all but the 1/10 of 1% of the wealthiest folks in the world have access to those top places. Without access to those places, it's extremely difficult to get that type of performance. And I'm going to say, we're going to talk about some products, two products in particular, IULs and fixed equity index annuities. And if it's a suitable product, look, if it is in your best interest, and everybody's different, it's not necessarily for everybody. But if it does fit your profile, I don't think there are better products in the financial services space than an IUL, properly structured, critically important. We'll talk about that in the next part of the series, structuring it the right way, or fixed equity index annuities. I don't see better products in the marketplace. Everybody should know what they are, know if they might be a fit. Okay? I want to give you a fact. If you go back to 1900 and you looked at the S&P 500's performance every single year up to the present, you would have found that 41 years out of that 125 years, the stock market actually went down. That's almost 1/3 exactly. Okay, so about a third of the time the market's gone down. Sometimes it's gone down a lot. And here's the hypothetical. If you could have eliminated all the down years and just been flat those years, okay, didn't absorb any of those declines in those 41 years when the market actually went down. If you had done that, all you would have needed to capture from all the upside, from all the other years, is 34% of that upside in order to get total stock market performance. We're all looking for stock market performance. That's the best performing asset class, period. It's the best asset class. It's called a risk asset for a reason, because there's a fair amount of risk associated with it. Not so much over the long term, but timing does matter. Okay. So if I could have eliminated all the downs and just been flat those years, I only needed 34% of the ups to get the best performing asset class of any asset class in the world with none of the downside, none of the headaches of I'm down 50%. Imagine that. The two products I mentioned already, they do exactly that for you. Okay. They take losses off the table and they do so contractually. You do not absorb losses in the years that the losses take place. So how closely can I approximate getting 34% of the upside in these types of products when I've taken losses off the table? Well, we could find you a growth annuity today where we peg your growth to 50% of what the S&P 500 does every year. We only need 34 to get the market performance in the last 125 years if losses are off the table. This annuity will give you 50%, 50. We could put you into an IUL today where you get 100% of the S&P 500's performance up to a cap of 12.75%, tax-free. You don't pay taxes on that. So hopefully that has your attention. These are really incredible products as part of your asset allocation strategy. That's what we're talking about here, okay? We're not talking about putting all our money anywhere. Nobody should be doing that. But we're talking about true, honest diversification with some portion of my assets in a product, in an asset class, if you will, that does what I just explained. I cannot lose my money. And can I capture 34%, 40%, 50% of the stock market's upside? Absolutely. Let's talk about where we are in the market today, okay? What I just told you, that is a strategy for any market. That deserves an allocation of your assets. Any market. I don't care where we are. Stock market's expensive, stock market's cheap. That is a strategy that makes sense. That is an all-time, I should always have some allocation to that type of strategy. But if we're in a market where the stock market is unusually risky, meaning it's more expensive than usual, then the strategy that I just described, IULs, fixed annuities, they are really powerful and compelling. You've all heard of Warren Buffett. Warren Buffett's considered one of the best investors, value investors ever. Nobody better. Back around 2000, when the tech bubble was taking off and there was talk of a new economy, and investors like Warren Buffett were, quote, dinosaurs. You know, we got to be thinking about how we invest in a different way. Buffett came out with what he called, what came to be called the Buffett indicator. He said, you know, basically, I'm an old-fashioned guy. I look at things, I look at cash flow. That's what drives the value of an asset. And I need to understand what is the cash flow potential of whatever it is I'm buying, and how does that compare to what I have to pay for it? So the indicator he came up with, what if I take the value of the stock market, just the total value of the stock market, the S&P 500 index, we could do some other index, and divided it by the underlying economy. The economy is what drives all the cash flow, supporting the stock market's value. So in his opinion, the best measure of whether the stock market's expensive, cheap, or fairly valued is just taking the value of the stock market and dividing it by the value of the economy. This is the history of the so-called Buffett indicator. This middle line here is a historical trend line. Today, we are 2 full standard deviations above the trend line. Standard deviation is a statistical term. 1 standard deviation away from the norm, we expect reversion to the mean. Okay, we expect this to cycle around the historical trend line. That's what's expected. That's what's always happened. 2 standard deviations above normal, means you need a 69% correction in the S&P 500's value today to get back onto that trend line. 69% downside in the stock market from where we are today. The Buffett indicator has never been higher. It's never been higher. The Shiller PE ratio. Shiller won a Nobel Prize. The Shiller PE ratio takes the S&P 500 index, just the index itself, and divides it by this, what's called the cyclically adjusted earnings of the S&P 500. Okay, the same companies in the index. What are their earnings? If we turn those into a composite, what are those earnings over a full cycle? Full cycle earnings. By looking at a full cycle of earnings, that Shiller PE ratio today can be compared apples to any point in history. That ratio today is almost 40x. It's only been higher one time. As you can see, that was 2000, the height of the tech bubble. That valuation gave way to a 75% drop in the value of the NASDAQ, 75%, and a 50% drop in the S&P 500. That's what happened in this period. That's what happened. That's what these drops are. Other than that, you've never been higher. Okay. Prior to 1980, the Shiller PE ratio cycled around 13 and a half times very consistently for 100 years. Why is it from 1980 to 2025 that the S&P 500 index has increased 60x, 60 times, while the underlying earnings of the S&P 500 in that same time frame have increased 4x? Why would the price go up 60 times when the actual earnings that support the price only went up 4x? This 39.72, in order to get back near that 13, 14x that we saw for 100 years, needs to drop 70%. S&P 500 needs to drop 70%. Remarkable how close that is to the Buffett indicator. It's not a question of if, it's only a question of when. And when is a big question. 10 years ago, some of the smartest investors on the planet 10 years ago would have told you emphatically the stock market is at ridiculous levels. It's totally unsustainable 10 years ago. The market's gone straight up since that time. Now, were they wrong? It's not that they were wrong, because there was a follow-up to pointing out that the stock market was crazy expensive, and now more crazy expensive today than it was then. Back then, you had what I would call a safety net in the form of the bond market, the yields in the US bond market. You've never seen the US stock market correct 20% or more with the US 10-year bond yielding less than 4%. Well, why is that? Institutional money, typically 40% of institutional money sits in bonds. That's the risk-free asset class. Okay, bonds. If the yield on bonds gets so low that it's hard to justify keeping the money in there, take, for instance, most of the last 10 years when the US 10-year was yielding less than 2%. After inflation, it was a negative yield. So where's the money going to go if it comes out of the stock market if the bond market's yielding negative returns or inadequate returns? So as long as that 10-year is below 4%, that's considered a safety net. A big correction in the stock market's unlikely. It's like never happened. Well, that safety net's gone. The US 10-year is over 4% now. So that's gone. That's the difference between 10 years ago and where we are today. So again, crazy expensive market, guys. We're talking 50, 60, 70%. That's the downside. I don't know when it will happen. Maybe it's 10 years from now. Maybe it never happens, but to me, it's going to happen. It's just a question of when. The levels of risk in the market today are off the charts in historical terms. Let's look at some of the big corrections historically, okay? The idea that, we'll bounce right back if that happens, that's a Wall Street myth, okay? Here's a history of some of the big corrections that we've seen. You go back to 1909, the antitrust era in this country, when the telephone company was broken up and other companies that were considered to have monopoly type power were just broken up. That wasn't a good time for the stock market. And we saw a 64% drop. It was more than that, peak to trough. But if you just look at annual performance, a 64% drop from October of 1909, the peak, over the next several years, the market dropped 64%. To get back to the peak of October 1909, adjusted for inflation, which we need to do, it took 19 years. 19 years before you got back to where you were. The market crash of 29, September of 29 was the peak. Again, north of 60% peak to trough. 30 years on an inflation adjusted basis before the market got back to where it was before that crash. In 1968, we had very high double-digit inflation as well as double-digit interest rates. The Fed started to tighten. That initiated a very protracted period of malaise, a weak period for the market, where from peak to trough, we got as low as 60% below peak levels that we first saw in December of 1968. 24 years later, we got back to where we were before that downward trend began in December of 68. 24 years. Let's go back to the tech bubble. August of 2000, we peaked. Over 50%. Again, this minus 46 is annual numbers. Over 50% drop. It took 16 years from when that tech bubble first started to collapse before we got back to where we were. Okay, before you got your money back. And the financial crisis of 2008, the peak was July of 2007. The crisis happened in 2008. Again, it was over 50% in the S&P 500 peak to trough. And despite the Federal Reserve printing money, having interest rates at negative real levels, basically, you got to pay the government to lend the government money. You got to pay them to lend them money. That's what negative real interest rates mean on the 10-year. Despite that, trillion-dollar deficit spending in DC, it was still 7 years before the stock market got back to where it was before the financial crisis collapse. Now ask yourself a question if you're retired or approaching retirement. Do you have 16, 20, 30 years to recover a 50% drop in the value of your retirement account? What about a 30% drop? Do you have that kind of course you don't have that kind of time. That's why finding ways to put a floor on some portion of my assets is so important. I need to take loss of principal off the table. Now, that's not good enough, okay? But that's the first box I need to check. Then I need to ask myself, how do I combat inflation risk? I don't want to just put my money under the mattress. I take principal risk off the table if I do that, other than somebody breaking into my house and finding my money under the mattress, of course. But I've done nothing for inflation risk if I stick my money in a shoebox in the closet. Again, IULs, fixed equity indexed annuities. They're giving me stock market-like upside while putting that floor of I can't lose my money. And each year I lock in my gains. I can't lose the gains once I've locked them in. Alternative assets. Okay, I want to make a big statement. 60% of the money in stocks, 40% of the money in bonds. That's the traditional notion of diversification. I've got a diversified portfolio. Okay, I'm not going to get destroyed here in a big correction in the stock market with 60-40. That broke down. Okay, that broke down the tech bubble, that broke down during the financial crisis. And what started to become more popular or more recognized in the market was the use of what I talked about at the outset, alternative assets. Assets that give me much of the upside, but give me a floor. Okay, not a floor of zero, but just a low correlation to what happens in the stock market. So you don't need to know exactly what's in here, but basically we're overlaying a hedge fund allocation to 20% of my portfolio instead of that traditional 60-40 portfolio. If I put a 20% allocation to alternative assets, And this is real data. Okay, what does that extra 20% in alternatives do for me? It increases my returns, okay, the left side of the axis, and it does so with less risk. What a winner, right? Let's do it. Here's the problem. The data in this chart is across long periods of time. Okay, so this is what's normal. This is what happens in normal times. But the diversification, the protection that we need is not protection in normal times. It's protection under periods when the stock market is extremely stressed. Okay? Doesn't work in that kind of environment. What this chart shows you, these blue bars, blue columns, for a whole series of asset classes, some of them more in the alternatives asset class than others, but all of these asset classes here, international stocks, emerging markets, high yield bonds, global bonds, real estate, natural resources, these are all considered uncorrelated asset classes. So they help me diversify my portfolio, my asset allocation. I'm diversified if I'm in these things. A correlation, which is on the left call, uh, uh, axis here, excuse me, of 0.5 or less is considered a low correlation, i.e., I'm diversified. Here's what happened. The blue bars are across full cycles. Nice low correlations, making me feel comfortable I'm diversified. And if the stock market crashes, these other assets are going to protect me. The red columns are what actually happened to those correlations during the financial crisis when the stock market was in fact crashing. And I needed that diversification. Look what they did. They all spiked materially, became far more correlated. People panic when the market's cratering. They run to cash. They sell everything they can sell to go to cash. That's what happens. And people learned the hard way. The diversification I thought I had when I needed it most was when I learned I never had it in the first place. So, what am I getting at? The traditional modes, the traditional tools for diversifying, for mitigating my downside while allowing me to participate in the asset class that gives me the best returns, the stock market. Those tools haven't worked. They have not worked. So again, coming full circle, there are tools available to us. I don't have to be a wealthy person to have an IUL. I don't have to be a wealthy, I don't have to have $1 million in my 401k to be worried about protecting it. These are products that can be tailored for where you are in your life, in your career, in your earning cycle, okay? Structured properly for where you are, the resources that you have, your income, your plans for retirement. IULs structured properly. Kyle Busch has filed a big lawsuit against Pacific Life. Why? Because he had an agent that structured his IUL diametrically wrong, the opposite of what you're supposed to do. In our next two sessions, we're going to get a little deeper into the weeds on annuities, the right types of annuities, the right structure for annuities, and then in the third, the same for IULs. So we're not going to tackle all that today. Just wanted to give the bigger picture to give you the sense that it's a call to action, folks. It really is. We're not saying let's get into the bunker and not come out for the next 2 years. We're saying let's put some portion of our assets into something where I'm still going to participate if the markets remain buoyant, even though they're defying gravity in terms of valuation. What if they keep going up? I'm still participating and I'm locking those gains in every year that happens. But I'm protecting myself for that reckoning. If and when that reckoning happens, I don't participate. And the next year, I'm right back to my participating in the recovery of the market. Zero downside risk to principal and zero downside risk to any of the gains that I've booked over time. That's what we're talking about here. And again, look at the facts. if I could have taken losses off the table in the last 125 years, I would have only needed 34% of the upside when the market went up. Only 34%. And I would have done the entire market performance, which is the headline that we all are chasing to begin with. Long-term market performance. I could have gotten all the total market performance if I only captured 34% of the upside, if I were able to eliminate the downside. That's what these two products do. They do it contractually. Okay. And when we talk in the next two sessions, we'll talk about carrier risk, which is important. Very conservative companies, generally speaking, but not all of them fall into that category. Now, we want to have individual conversations with anybody who hears this and wants to have an individual conversation. Okay, we must observe your best interest. We're fiduciaries. Okay, so that's the requirement, and we're here to try to help people. So let us know. This is the best way to reach me. And Brian's information, my partner, Brian Mitchell, he's on all the information you received to get to this point in the webinar. So contact either one of us and let's set up an individual conversation and see if this makes some sense for you.